Hello, Dr. Crone here. Welcome to our video on state budgeting. This is the first of two videos in our state budgeting and taxes unit. I bet you can guess the second one is about taxes. This is our last unit. Major shout out to you for making it this far in our online version of the course. So to understand budgeting, you got to start by understanding what fiscal policy is. So fiscal policy has to do with the kind of policy that's passed that has to do with taxing and spending in government. So fiscal policy has to do with governments making decisions about where their revenue is going to come from, what kind of taxes or what kind of sources they're going to have for revenue. Some of that will be revenue sharing, money from the federal government and or from other states if they're involved in a multi-state project. But a lot of that's going to come from the taxes and fees that they charge. And then also how to spend that money. So they have to make laws about how they're going to get money and laws about how they're going to spend the money. And fiscal policy has economic and political consequences for the state. So different parties have different ideas about what fiscal policy should be, different ideologies, different governors and state legislature members. So it really is a political process of setting fiscal policy. So the concrete way that they do this is via what's called a budgeting process. And every state has a cycle for budgeting. Your textbook goes into much more detail, and I do want you to read that about budget cycles. Ohio has a 2-year budget cycle, meaning that right now we're in the expenditure part of a 2-year budget cycle. Last year was our first year in the budget. The budget got passed in June. And so we won't have another what's called operating budget until next year. At this time, we'll be in the process of setting an operating budget. So we have a 2-year cycle. A lot of states have a 1-year cycle. You'll be learning more about the cycle in your own state through your research in Activity 5 this week, which, by the way, you can do as a group if you want to work with your group, or you can do it completely on your own. You just do need, if you do it as a group, everybody needs to submit their own version of the answers. So in a state, there are two kinds of budgets. The first kind of budget that we'll talk about is called an operating budget. And the operating budget is for the normal expenditures of the state. Basically what that is it's a budget that sets how much income is expected to come in from taxes and fees and things like that, and then how that money is going to be spent. And all of that money gets spent within that 2-year budget cycle. And the budget has to balance, which we'll talk about in just a bit. But basically a balanced budget means that no borrowing is allowed. So the expenditures have to be more or equal to the income has to be more or equal to the expenditures. So that's one kind of a budget. There's also something called a capital budget, which we're going to talk about towards the end of this video. That is different kind of sort of investment money in the state for large ongoing expenses, mostly things like building or maintaining public buildings like school buildings and things like that. But we'll talk about the capital budget first. Next, the first thing we're going to talk about is the operating budget. So an operating budget is really involves two types of spending. So there's two types of expenditures within an operating budget. Remember, an operating budget is just your normal everyday state budget. There's mandatory spending, and that's just like it sounds. That's spending that the state has no control over because it's required by law, usually a federal law. So for example, Medicaid spending at the state level is something that the state of Ohio can't do anything about. That's a federal program. They can add to the federal program, but there's a minimum that they have to provide. And it's basically based on how many people in the state qualify for that. So the state can't cut, for example, cannot cut the basic mandatory Medicaid budget. So Medicaid's the biggest example of mandatory spending. The second category of spending is called discretionary, and that's all the rest of the stuff, which are considered optional and which states could cut So for example, road repairs or the amount of spending for schools or things like that. All of those are considered discretionary, and it's basically all the stuff that we would think of as important government programs. Because states can change that. The federal or the state legislature and the governor can change those things. So this is just an example. I believe this is no longer our current operating budget, but this is an example I found several years ago of the Ohio operating budget. And a big chunk of that, about 40% of that, is mandatory spending via Medicaid. The other things that you see here are mostly discretionary spending. So things like spending on higher education or primary and secondary education, justice and public protection, that has to do with state corrections facilities, health and human services, that's welfare programs, unemployment, stuff like that. So that's all open. Most of those things are open to the legislature changing them in the next budget year, saying, well, we spent too much on that, we need to cut that section down, or we need to add to that section. This is another way we can look at the expenditures in a state budget. So on the left, you see what are called total state expenditures, and that includes spending of state and federal funds. So here you see that Medicaid spending makes up about 30% of the total state budget. And this is a different year than the one we had before. But on the right, you see if we're just accounting for the expenditure of state money, you see that Medicaid is a smaller chunk of that because a lot of our Medicaid spending is money, cooperative federalism money that comes from the federal government. Medicaid is the ultimate cooperative federalism program. But here you can see, especially on the right side, these are the things that the state government has control over, and you can see that K through 12 education is 25% of the budget. A quarter of the budget goes towards that. If you include higher ed in that, it's a major chunk of the budget. Far more than a third of the budget goes towards, it's actually higher than 40% of the budget goes towards education. Where you see things like corrections and transportation are much smaller. And then you have that lovely category all other, which includes all kinds of things. So the process of creating an operating budget is really what lawmakers spend most of their time on, and it is a challenging task, to say the least. It's a very busy part of a state lawmaker's life is setting the budget. And the reason why it's tough or it's stressful is because there's a lot of issues that go into state and local budgeting that make it hard to create a budget. There are a lot of political constraints on state and local budgeting. For example, taxpayers, who don't like to pay taxes. We'll talk about that next time, and they certainly don't like it when their taxes are raised. Interest groups who are trying to put pressure on lawmakers to fund their special project. Which political party is in power, and the minority party certainly doesn't have very much of a say in the budgeting process, but they want to try to. There are a lot of political tussles going on in the budgeting process. But there are other constraints that are really sort of beyond the control of the state political system. Things like bad economic conditions, like we're in right now with a bad recession. How much federal money and federal revenue sharing is available, that fiscal federalism money that they count on. Fluctuations in how much things that the state needs to purchase cost. You know, for example, if the state needs to purchase a bunch of new salt trucks to lay salt on the roads, you know, do those cost more than they did the last time they were done? Or how can a state get the best price on that? And is the price higher than what they would like to pay? So all of these things are constraints and make the budgeting process difficult. But the most important thing that makes the budget difficult at the state level, the hardest thing about it, is that most states have a requirement that the budget balance. We'll talk about what that means in a minute. But what's interesting is that most states, actually 49 of the 50 states, have some requirements saying that the budget must or should balance. But the federal government does not have that. So let's look into what balanced budgeting is. Balanced budgeting means that the budgeted revenue, in other words, what they are expecting to come in from taxes or fees or revenue from the federal government, that money, that pot of money that they have to spend must equal or exceed their planned expenditures, their planned expenses that they're going to buy or pay for. So to be really simple, most families try to operate out of a balanced budget. You maybe as a college student will need to operate out of a balanced budget. And to balance budgeting for a college student would be something like, okay, what income am I going to have in a semester? Maybe I have a part-time job, and maybe my parents are going to help me pay for some of my living expenses. So what is that total combined going to be like? So you figure out what income you'll have, and then you figure out what your expenses will be. Maybe you have expenses like rent or groceries, or you want to pay for entertainment, to go out, hang out and eat pizza or go to the movies or something like that. Maybe you have a car payment. Maybe you have to pay for your car insurance or gas. Maybe you have to buy books for your semester. All of that are your expenses. And in order to make a balanced budget, your income, your planned income, has to exceed your planned expenditures. If it does, then your budget will balance. And that's pretty much a simplified version, but that's pretty much what states mean by a balanced budget. Their revenue has to equal or exceed their planned expenditures. And like I said, 49 states out of the 50 have balanced budget requirements. Deficit spending is the opposite of a balanced budget. And deficit spending for a government means planning to spend more money than comes in revenue. And the difference between the expenditures that are planned minus the projected revenue is what's called the deficit. And governments can make up the difference between their planned expenditures and their planned revenue. If there's a difference that way, they can make it up basically by borrowing money. The way that a government borrows money is that it sells bonds to investors, and it says to those investors, you give us $10,000 and we will gradually pay you back with interest. Just like when you take out a mortgage, when a homeowner takes out a mortgage or a car loan or something like that, and you say, give me this money to buy a car, and then I will gradually pay you back. Governments do that by selling what's called bonds to investors. And the US government, for example, has an enormous deficit. The projected deficit for fiscal year 2020 is $3 trillion. Now that's the highest it's ever been. That's incredibly higher than the 1 trillion that it had been for the past several years, approximately 1 trillion. That's partly because of the money that's being spent to help with the recession right now for the coronavirus stimulus. But it's an enormous difference between the income that the US government takes in and the outgo. When you add together all the deficit for all the years that have not yet been all paid back, our debt as a country is $25 trillion, which is almost hard to believe. It's over 100% of the gross domestic product of the United States in 2018. So that means that even if we spent every single penny that everyone in the United States made last year, we could pay off the debt if we could somehow spend all that money. So that is an enormous amount of money. If we go back to our simple college student example, deficit spending is like you as a college student not being able to afford to pay for beer or pizza and borrowing that money on a credit card. So in some ways, the deficit or selling bonds is a little bit like the government continuing to use a credit card. So you might think to yourself, Well, that sounds crazy. I've heard of problems with borrowing. I don't want to use a credit card, and maybe the government shouldn't do something like that too. But actually, there's at least a large school of thought in economics that says for a country, it's not necessarily that bad to have that much of a deficit. It's what's called Keynesian economics by a guy named John Maynard Keynes. His thinking came into use by the government in the 1930s. This was the borrowing to fund our way out of a recession, was how we got out of the Great Depression, and certainly how we won World War II. And the idea here is that now, if a country borrows now, it will increase the country's growth and will increase the income, and so therefore paying back the loan will be not as hard as it was in the past. That's basically Keynesian economics in a nutshell. But that most states aren't allowed to run deficit budgets, and the reason for that is because unlike the US government, the states don't have as much control over their own economies as a nation state does. States don't have their own currency, they can't control the value of the currency. And actually, states have a lot more effects of other states and the national governments on them and their economies. So most states have decided it doesn't make sense to have a deficit budget. Keynesian economics doesn't say it would be as good of an idea for a state as for a national government to do that. And so for that reason, 49 out of the 50 states have some type of balanced budget law. However, not all balanced budget laws are the same. So we'll look at the differences among states. So this map, it's a little bit old, but it's still mostly applicable. This shows us different shades for the levels of what's called stringency in budgeting, or the strictness of the balanced budget laws in the states. So some states have a much stricter definition of a balanced budget and much stricter requirements that work in the state. It kind of varies from one state that doesn't even have a balanced budget requirement up through states that have what's sort of basically like a suggestion to balance the budget, to ones like Ohio, where there's a very strict law that says the budget cannot go into effect until it balances. And I think that the analogy there is, some parents are stricter than others. Everybody knows that some parents will enforce a rule like, let's say, a curfew with very strict consequences. If you break curfew, you can't use your car anymore or something like that. For other kids, their parents' curfew is more of a suggestion, and they're able to get out of it without any punishment if they come home late or whatever. And that's kind of how it is with state balanced budget laws. So one thing you're going to get to do in your activity 5 is to research how strict your state laws are. So balanced budgeting can be really difficult. It's not as easy as it sounds, if it sounds easy. And that's because one of the things it requires is forecasting. And forecasting is to try to tell the future, essentially, to try to figure out what are your income and expenses going to be. And estimating your revenues and your expenses can be very tricky, and especially estimating your revenues. It's a little easier when you're a college student, because if you have a job where you're going to work 20 hours a week and you know what salary or what hourly wage you're going to get, it's a little bit easy to estimate what that'll be. But for a state to estimate their tax revenue is difficult because right now, for example, a lot of people have lost their jobs, and so they will not have as high of an income, so they're not going to be paying income tax. They may not be buying as many things. They're not going to be able to afford to buy new clothes or a new car or something like that, and so the state will lose out on sales tax they had been hoping to get. So it's really difficult to project, especially to project revenue. And so states try to rely on things that can help them hedge that. One thing is to try to get the best expert opinions and forecasts for what the economy will be like going forward. And of course, that's always a tricky thing to do. One thing that Ohio does is it allows a sort of a rebalancing of the budget halfway through the budget cycle, to take a look at things and say, you know what, we aren't getting the money in that we thought we were going to, so we're going to have to cut our spending. And then finally, a lot of states have established what are called rainy day funds, which is basically like a state savings account. So when there's a good year economically and maybe taxes and income is higher than they thought it was going to be, they can put that money away rather than having to spend it all. They can put that money away and save it to be used in a year when their revenues are lower. And I just heard a report by some political reporters on NPR, State House reporters who've talked about how it's officially a rainy day now and the state is using rainy day funds to try to meet their expenses because revenues are bad and probably going to get worse. So we just talked about the operating budget, and hopefully you understand that. If not, please get in touch and I'll be happy to explain it. But I also wanted to remind you that there is another type of a state budget. It's called the capital budget. And this type does allow borrowing. So the operating budget has to balance, but the capital budget does not. The capital budget is for long, ongoing, big expenses that last a long time. Things like building a new building or building a new bridge or something like that. And the idea here is those are the types of spending that make sense to borrow for. Just like most people borrow in order to make a large long-term purchase like a home or like a car. It makes sense for states to borrow for important long-term, very expensive items. And they use bonds in order to borrow that money from investors, which they then promise they'll pay back over a certain term with interest. And that's revenue from those bonds is what goes to pay for things in the capital budget. So just a little bit of, this is an example of a recent capital budget. It's fairly old and I didn't have time to update it, sorry about that, but this will give you a little bit of an idea of what a capital budget looks like. You can read these things and kind of see what types of things the state is allowed to borrow money for. We are currently in the process of putting together and then passing a fiscal year 21-22 budget. That will have to be passed by the end of June. So hopefully you keep an eye on, if you're a budget watcher, you can keep your eye out for news and things from Ohio to find out what's going to be happening in the next capital budget. And that's the end of our video lecture on state budgeting. There's one more video lecture in this unit, which will be on taxes. So be sure to watch both of them before you post in the discussion board. And a lot of what you need to do your activity 5 you've learned in this lecture. So hopefully that'll help you get a start on that. I will see you next time. Bye-bye.